In capital budgeting, while arriving at the cash flow after tax, we will be adding back interest with the profit after tax along with depreciation to find out what is the cash flow after tax. Why we are adding back interest? It's because of this principle, that is exclusion of financing cost principle. How that works? Let's see. Let's say my sales is 100 million, my expenses are 50 million, interest on long term funds is 20 million, depreciation is 10 million. So if I deduct all this, I'll get profit before tax of 20 million. Let's say the tax at the rate of 30% is 6 million. So profit after tax is 14 million. With this, we have to add back depreciation because it is a non-cash item, so that is 10 million, and we have to add back interest. We are adding back interest because of this exclusion of financing cost principle. Why? Because this interest is already factored in discounting rate and we'll be using that rate for finding the present value of cash flows. You'll be understanding that little later. But while adding back, there is a caution. So what amount I should add back? What I have subtracted here, minus 20. So how much I should add back? Should I add back the same 20? Answer is no. That can be misleading. Why? Because the presence of interest of 20 had some role in the tax amount. Because had there been no interest, then tax amount would have been little different. I'll show you that. Look at here. If there is no interest, then the profit will be 40, and 40 into 30%, the tax will be 12, and profit after tax will be 18. So definitely the presence of interest has influenced the tax. So when I add back, I should not add back just the interest amount. I should also take into cognizance the impact on the taxes. How do I do that? It is very simple. Take interest, multiply it with 1 minus t, that is the tax rate. So in this case, interest is 20, multiply it with 1 minus 30%, so you will get 70%. 20 into 70%, you will get 14. So just take this total, all the three. So you get 38, and that is going to be the cash flow after tax adjusted for depreciation and interest after considering the tax effect on interest. If I don't do this, what will happen? If I don't do this, then the cash flow what I calculate can be misleading. Because through this exercise, do you know what we are trying to find out? We are trying to find out what is the cash flow after tax before paying interest. Okay, we are trying to see a scenario where there is no interest, and in that case, what is the cash flow? Because interest is going to be considered in discounting. Okay, let me also show you how this actually works. Look at here. Here we have assumed there is no interest. If there is no interest, this is the profits, this is the profit after tax, right? So here, if I add back the depreciation, it's plus 10, and there is a correction here. 40 minus 12 is 28, not 18. So 28 plus 10, and what I get is 38. Look at here, it matches. So what we are attempting in this exercise is, we are trying to find out what is the cash flow after tax had there been no interest. Instead, if you just add the full amount of 20, that is this 20 over here, then here you will not have 38, rather what you will have is something like 44, and that is misleading because the actual cash flow position is going to be only 38 million.